Today, we are diving deep into title insurance for the National Real Estate Exam. You need to understand that title insurance is uniquely retrospective. Unlike your car insurance or your homeowner's insurance, which protect you against things that might happen in the future, like an accident or a fire, title insurance is specifically designed to protect against things that have already happened in the past, but remain undiscovered until after the closing. This is a major concept on the exam because it is the only form of insurance that looks backward instead of forward. On the national portion of the exam, you will likely see questions asking about the primary purpose of title insurance, and the answer will always involve protecting against losses arising from defects in the title that existed before the policy was issued. Imagine a scenario where a property was sold 10 years ago, but the deed was forged, or perhaps there was a secret heir to the estate who never signed off on the transfer. These are the types of past events that title insurance covers. The exam will often test your knowledge of what specific items are covered, such as undisclosed liens, encumbrances, or even errors in the public record. One of the most common exam traps involves the payment of premiums. While most insurance involves monthly or annual payments, title insurance is paid just once at the time of closing. If a question asks about recurring costs for title insurance, that is a red flag intended to trip you up. You also need to distinguish between the two main types of policies, which are the lender policy and the owner policy. The lender policy, also known as the mortgagee policy, is almost always required by the bank, and it only protects the lender amount of the loan. This means as the mortgage balance goes down, the coverage of the lender policy also goes down until it eventually hits zero when the loan is paid off. On the other hand, the owner policy is typically for the full purchase price of the home, and it stays in effect for as long as the owner or their heirs have an interest in the property. A classic exam question might ask which policy decreases over time, and the answer is always the lender policy. Another critical concept is subrogation. This is the legal process where the insurance company, after paying a claim, steps into the shoes of the insured to sue the party responsible for the title defect. If the exam asks how an insurance company recovers funds from a negligent third party, the term you are looking for is subrogation. To keep all of this straight, remember the phrase, "the past is the point." Title insurance looks back at the past to ensure your future ownership is secure. We also see questions regarding the preliminary title report or the title commitment. These documents list the exceptions to coverage, such as existing easements or zoning ordinances that the insurance company will not cover. You must remember that title insurance does not cover everything. Specifically, it usually excludes any defects that a physical inspection or survey would have revealed if they are not already in the public record. When you are sitting for the exam, look out for trick wording that suggests title insurance protects against future events, like a storm or a new lien you might incur next year. Always steer back to the idea of protecting the chain of title from historical errors. By focusing on the retrospective nature, the one-time premium, and the difference between lender and owner coverage, you will be well prepared for any title insurance questions the national exam throws your way.